12 days ago, 25% of SCHD's portfolio disappeared. Now, how and why in the world did this happen? How does 25% of a stock portfolio of an ETF just disappear? Well, that's what we're gonna have to figure out in this video. We're gonna have to figure out, first off, why this happened, and then second, did the new stocks that went into the portfolio that replaced those 25%, are they any good? Are they even better than the 25% that were replaced? Did SCHD actually just get better, or is it actually worse? In order to answer this question, we have to start with a graph. Let's first understand what SCHD is and how it gets stocks in its portfolio so we understand what just happened here. Now, if you've watched my videos before, you might have seen this already. Let's go over it again because let's get briefed on this so we understand we're on the same wavelength here. So the way SCHD works is first on the left side, this is where it starts. All these potential stocks that can go into the portfolio, and then where it ends is 100 stocks. This is how it gets from those potential stocks over to the stocks that it puts in the portfolio. So here's how it goes. We start off with the Dow Jones Broad Market Index. So technically there's just over 2,500 stocks that are eligible in this index. Now we have to take out REITs. SCHD does not invest in real estate investment trusts. So I'm just gonna be approximate here. There's say 225 REITs inside the US. We're left with about 2,300 stocks after that. Now here's where things get really interesting. We have to figure out the universe of stocks we're going to go with. In order to do this, SCHD does a few different things. First off, it only selects companies that have a minimum of 10 years of consecutive dividend payments. So companies that don't pay any dividends and have not paid for the past 10 years, they're not gonna make it into SCHD. That's the first barrier to entry, let's call it. Then we have about $500 million companies that have to go into this. So you can have really small companies. We have to also have average daily trade volume of about 2 million plus. So those are the first factors we go through. Now, about let's say 1,800 stocks actually don't pass those criteria. So now those can't even go into SCHD. We have 450 left. Now, after we get to these 450, now we go through some really interesting fundamental factors. SCHD ranks some different things. So first off, free cash flow to total debt. Zero debt is going to be ranked first in this. So basically companies without debt, they're going to get better rankings. Then you have something called IAD yield. Just imagine that's the dividend yield of these companies. Then you have the shareholders equity. Basically, this is going to be the return on equity. That's going to be net income divided by shareholders equity, and then 5-year dividend growth rate. So what happens, let's think about this as a score. And so let's say these 4 different factors. Well, it gets a score for each factor, and the companies with the highest score, they can go into SCHD. Now, only 100 stocks can make it into SCHD. We had 450 to start approximately. So 350 stocks are not going to make it through this fundamental factor, right? They're not going to pass the test. We're only going to get the best of these different fundamental factors. So as long as these factors are good, we're going to probably get really good stocks. So now we have something called Reconstitution. Now, constituent weightings, we have 3 things here. Stocks in the index are weighted quarterly, so hence this is why this just happened recently. No stock can represent more than 4% of the index. So every quarter they go in and they say how many stocks are more than 4%, and they sell some of those positions to get it down to under 4. On top of this, they take a look at the sectors and they make sure that no sector is more than 25% of the entire ETF or the entire portfolio of stocks. So for example, if technology is 30%, well, they're gonna have to get rid of some tech stocks, or at least they're gonna have to weight the tech stocks less. Now there's another thing, just so we know what's going on here and understand what's going on in SCHD. There's something called a daily weight cap check. So remember how I said this thing goes quarterly, right? So every quarter they take a look, but there's another part of this. Daily, they look at something called a daily weight cap check. And if 22% of stocks have a weighting of 4.7% or more, then they're going to do some rebalancing there. So essentially during the year, you have different checks that's going on. Think of it like spring cleaning. You do a little organization in the house, you sweep some floors, clean all the surfaces, get that house looking spickety span. This is kind of what's going on with SCHD. The portfolio managers are making sure not one stock or one sector is taking over too much of the portfolio of SCHD. They're cleaning it up as time goes on. They're making sure it's nice and spickety span. Instead of just spring cleaning, it actually happens quarterly. So these are rebalancing months. There's March, June, September, and December, and it's the 3rd Friday of the month. And this is the reason that it was back on the 17th of March, which was a Friday. So is this a bad or a good thing? 25% of the stocks in SCHD have disappeared, but is that a bad or a good thing? Were they replaced with something better? First off, what was the biggest stock that was taken out of SCHD? The largest company was actually IBM, and it was about 3.6% of the portfolio back when I ran this about 3 or 4 weeks ago. Next, what's the biggest company that was added to SCHD? This is going to be AbbVie. So AbbVie is the largest company added. Now it's currently at 4.3% of the portfolio. Next question, what is the largest sector that was removed from SCHD? Well, the financial sector, and we all know the financial sector, there's a lot of interesting things going on, maybe a banking crisis. And so what companies were taken out of the financial sector here? 14 different companies. Out of the 25 stocks that were taken out, 14. That's a lot, right? That's 14% of the portfolio were taken out that were from the financial sector. We have Prudential, Hartford, Principal, Cincinnati Financial. So we have some different companies that are basically financial services companies. We have some insurers in here and things like that. So maybe it's a good thing that some of these came out. I don't know. We're going to discuss this coming up. We're going to compare some of the metrics before and after. We're going to come to a conclusion if it's better or worse. So here we go. Let's start. The first thing I want to go over is the average distribution yield. So think of this as the dividend yield. So all of the stocks that were taken out, right? The 25 or so stocks that were taken out, what was their distribution yield? Well, it was 3.61%. Okay, so what were the next, let's say 25-ish stocks that were added? How is that distribution yield? Well, their distribution yield is actually 4.83%. They have a higher distribution yield than the ones that were taken out. So as we can see, SCHD is actually putting in some higher yielding stocks into the portfolio. Hey, I like it so far. Let's take a look at some other metrics. Average PE, the price to earnings ratio. A higher price to earnings ratio could mean you're paying more money for a company based on its earnings. Now, sometimes that's a good thing, sometimes it's a bad thing. But a way to think about this is higher PEs are going to be more growth companies, lower PEs, more value companies. So is this going to be going more towards growth or value? Let's take a look. 17.7 times earnings was the multiple that was taken out. What was put in? Okay, the average PE was 13.1 times. So we're getting more value stocks that have higher dividends so far. So that's a price to earnings ratio looking backward, right? Previous earnings. Let's take a look at projected earnings. We're looking into the future. We're projecting earnings into the future here. So average forward PE, 12.8 times that were taken out. How about the ones that were put into SCHD? Actually a lower PE, a lower forward PE. So again, a little bit cheaper than the ones that were taken out. Next, we have the price to book ratio. Think of this as a multiple of the net worth of the company. Whatever the net worth of the company is, what's the multiple you're paying for that company? How many times of the actual net worth are you paying? Okay, well, we have 5.1 times the net worth of the company. The price to book value is what we have for the ones that were taken out, and the ones that were put in are actually at 4.4 times. So they're less expensive, more towards value than towards growth. Let's talk now about earnings per share growth. The median earnings per share growth of the companies that were taken out was actually negative 15%. Now this is for the year, right? So let's say this year. Okay, next up, the ones that were put in, they actually had positive median earnings per share growth, 2.7%. So that's actually pretty good. So we got a lot of factors pointing out to stocks that have really good fundamentals right now. I'm liking it so far. Let's keep going though, and let's see what happens next. We have median earnings per share growth next year. Now this one actually is interesting. 12% is actually a bit higher than of the ones that actually came out from the ones that came in, which is actually 7.8%. So a little bit less there. But again, remember, the ones that were taken out actually had a much larger decline in the median earnings per share growth. So, you know, net, it's probably actually better the ones that were put in. And so after all of this has happened, what really is the result here? Well, to me, it's actually a much better result. So we have the financial sector, which is the most that are coming out of this portfolio. Maybe that's a good thing considering the potential banking crisis that's going on and interest rates hurting potential companies that are in the financial services sector, maybe. But then again, we have a better distribution on the ones that went in. Distribution yield, 4.83% versus 3.61%. We have a lower PE ratio, so more value oriented for the ones that are going in. We have a lower price to book value also for the ones that are going in. So that's also a lower, more towards a value oriented number of stocks going into the portfolio. We have better earnings per share growth as well. All these factors to me seem very good. So am I happy with the companies that have gone into SCHD? Based on this, I am. But what about an ETF to actually pair maybe with SCHD? Take a look at this video here and disclaimer here. See you next time.